The trade war backfire. How Trump's tariff gambit is handing China the upper hand. In the high-stakes arena of global trade, President Donald Trump's aggressive tariff strategy was billed as the ultimate weapon to reclaim American manufacturing dominance and reign in China's economic juggernaut. For months, the administration has layered on duties, promising a flood of jobs back to U.S. shores and a crippling blow to Beijing's export machine. Yet, as the dust settles on the first 9 months of 2025, the data paints a starkly different picture. China's economy isn't buckling, it's surging ahead, while America's heartland factories and family budgets bear the brunt of the fallout. This isn't just a policy misstep, it's a slow-motion unraveling of U.S. economic leverage, exposing vulnerabilities that could redefine global power for decades. China's export boom, defying the tariff squeeze. At the core of Trump's plan was the idea that sky-high tariffs would choke off Chinese goods flooding American markets. Instead, Beijing's exporters have adapted with ruthless efficiency. In the first half of 2025, China's trade surplus ballooned to a record $586 billion, a staggering 34% jump from the previous year. This figure, equivalent to roughly 6.3% of China's GDP, marks the highest surplus to GDP ratio in over a decade, underscoring a resilience that mocks Washington's pressure campaign. Exports in the third quarter alone approached $950 billion, driven by demand from Europe, Asia, and even a tariff-dodging pivot to non-US markets. Chinese firms have mastered the art of circumvention, rerouting shipments through Southeast Asian hubs like Vietnam and Thailand, where goods are rebadged and exported under different origins to avoid tariffs. Others exploit loopholes in trade codes or front-load shipments before new tariffs take effect. The result? US import bills rise, but China's coffers swell. This isn't a fluke, it's strategy. While direct exports to the US dipped 21.6%, overall export growth hit 7.2%, proving that Beijing's diversification plan is working. China isn't under pressure. It's capitalizing on America's self-inflicted wounds. The home front hit, tariffs, sting American wallets and workplaces. Back home, tariffs are backfiring badly. The effective U.S. tariff rate has soared to 17.9%, the highest since the 1930s, driving up prices on imported goods by an average of 1.6%. Construction materials like steel and lumber have jumped 15 to 20%, electronics by 10%, and daily essentials, from clothes to home appliances, are all costlier. Factories are the first to suffer. Manufacturing output has slowed to its weakest pace in 2 years, with job cuts and shorter shifts spreading across the Midwest. Major retailers like Walmart and Target report price hikes of 5 to 7% on imported goods. Job openings plunged to 7.2 million in August, a 10-month low, and 25% below the 2022 peak. Blue-collar industries like construction and manufacturing are the hardest hit, while white-collar hiring lags. For the first time since the COVID recovery, there are more unemployed Americans than available jobs. To make matters worse, a government shutdown stretching past 3 weeks has left 800,000 federal workers without pay, while programs like food assistance face cuts. The economic strain is visible across the country, an ironic contrast to the economic revival the tariffs promised. Beijing's counterpunch: rare earths and resource choke points. If tariffs were America's offensive weapon, China's counterattack targets a more strategic vulnerability: critical minerals. In October, Beijing expanded export restrictions on rare earth elements, now controlling 12 vital materials essential for semiconductors, electric vehicles, and even U.S. defense systems. China refines over 90% of the world's supply, giving it immense leverage. Prices for key inputs like lithium carbonate have spiked 40%, squeezing U.S. manufacturers and defense contractors. China's new rules explicitly ban military-linked exports from December 1st, threatening to disrupt America's missile and drone production. Building alternatives will take years and billions of dollars. For now, China's dominance in critical resources ensures that the U.S. remains dependent, undermining Trump's America First rhetoric. Financial tremors, from credit cracks to dollar wobbles. The trade war's impact has rippled into the financial system. September saw the bankruptcy of Tricolor and the $10 billion default of First Brands, triggering a mini credit crisis. Regional banks faced major losses, wiping out $100 billion in market value within days. High interest rates and tariff-fueled inflation are driving up defaults on auto, housing, and commercial loans. Consumer spending has cooled, while debt levels soar. The Federal Reserve now faces a dilemma: cut rates to avoid recession, or hold firm and risk deeper instability. Meanwhile, the US dollar has fallen 11% year-to-date, its worst performance since the 1970s. Foreign confidence in US debt is evaporating. China and Japan, once major buyers of treasuries, are pulling back, diversifying into gold and yuan-based assets. The dollar's decline isn't just an economic problem, it's a geopolitical warning. The shifting balance: can America claw back? What began as a bold plan for revival has turned into a struggle for survival. China's economy is thriving, exports are booming, and its control over critical resources is tightening. In contrast, America faces inflation, factory shutdowns, and growing debt. The trade war, once sold as America's comeback story, now looks like a strategic blunder that accelerated China's ascent. Whether the US can adapt by rebuilding supply chains, securing mineral independence, and restoring trade confidence will define the next chapter of global power. For now, one thing is clear: the tariffs meant to make America strong again may have just handed China the upper hand.